Are we witnessing a shift in the Canadian multifamily real estate market as new supply floods the scene? Welcome to the Multifamily Real Estate Insights Podcast. I'm your host, Sandy MacKay. Let's get right to it. In recent developments, the Canadian multifamily real estate market is feeling the pressure from both an influx of new supply and ongoing trade tensions with the United States. According to a report by Oxford Economics, the national average asking rent in Canada has seen a decline, dropping to $2,129 per month in May, marking a 3.3% decrease from the same month last year. This decline is most pronounced in major urban centers like Calgary, Vancouver, and Toronto. The report highlights that completions of new multifamily units surged by a remarkable 35% in 2024. This rapid increase in supply is expected to continue as a record number of purpose-built rental units are constructed and added to the market. While this could potentially lead to a more balanced market in the long term, the immediate effect is a downward pressure on rental prices. Oxford Economics also points out that weaker demand, driven by reduced immigration and fewer temporary residents, is contributing to the current market conditions. However, they note that the ongoing challenges in home ownership affordability and financial strains on households, exacerbated by a trade war-induced recession, will likely maintain a level of demand for rentals in the coming months. On the international front, tensions between Canada and the United States have been escalating, with former President Donald Trump threatening to intensify the trade war unless Canada rescinds its digital service tax targeting American tech giants. In response, Canadian Prime Minister Mark Carney's government has agreed to resume negotiations, aiming to reach a deal by July 21st. Nonetheless, uncertainty remains as to whether a resolution will be reached. Tony Stillo, Director of Canadian Economics at Oxford Economics, has remarked that unless an immediate resolution is found to lift the tariffs, the current housing slump is expected to persist through the end of 2025. Stillo anticipates that the resale housing market will struggle to recover due to poor affordability, weak consumer confidence, and job losses stemming from the recession. Despite these challenges, there is a silver lining as CoStar Market Analytics suggests that the multifamily market may be undergoing a rebalancing. In particularly unaffordable urban areas such as Toronto and Vancouver, vacancy rates are approaching more balanced levels. This could signal a healthier market environment in the future, even as Alberta experiences cyclical highs in vacancy rates. In a significant move within the Canadian multifamily real estate sector, Morgan Properties, a leading apartment management company based in Pennsylvania, has announced its intention to acquire Dream Residential Real Estate Investment Trust, a Toronto-based investment trust. This acquisition includes Dream Residential's portfolio of 3,300 multifamily units. The acquisition is part of Morgan Properties' strategic expansion plan, focusing on high-growth regions in the United States, specifically the Sun Belt and Midwest. This move underscores the company's commitment to broadening its footprint beyond its traditional markets. Dream Residential REIT is located in the heart of Toronto at 30 Adelaide Street East, and this acquisition by Morgan Properties marks a pivotal moment for the Canadian real estate market. It's a testament to the attractiveness of Canadian multifamily assets to international investors, particularly those from the United States. With this acquisition, Morgan Properties aims to leverage its extensive experience in property management and investment to enhance the value of Dream Residential's assets. This move is expected to bring about operational efficiencies and potentially enhance tenant experiences across the portfolio. As the multifamily market continues to evolve, this acquisition highlights the growing interest from U.S. investors in Canadian real estate, particularly in the multifamily sector. It's an exciting time for the industry, and we're likely to see more cross-border investments as the market dynamics shift. As we look ahead to the Canadian real estate market in 2025, it's clear that the country is at a pivotal juncture, both politically and economically. According to a report from CBRE, despite facing challenges like housing affordability and congestion, Canada continues to be a promising market for growth. The nation is projected to be among the leading G7 countries in terms of GDP, population, and employment growth over the next 5 years, all of which are closely tied to the demand for commercial real estate. The report indicates that 2025 is expected to be a year of heightened activity in the real estate sector. With the cost of capital crisis beginning to ease, there's potential for an uptick in investment and leasing activities. This is contingent, however, on the conditions in the global bond market. On the whole, the fundamentals of leasing are improving, although Canada is experiencing significant new supply in office, industrial, and residential sectors, which will take time to absorb. CBRE's analysis suggests that on the economic front, even with modest economic growth forecasts due to immigration restrictions, Canada's long-term outlook remains strong compared to other G7 countries. This is positive news for the demand in commercial real estate, providing a stable foundation for future growth. In terms of capital markets, there's an optimistic sentiment with expectations of stronger investment activity in 2025. More capital is anticipated to be mobilized, leading to potential compression in cap rates for some asset classes, though this will depend on the global bond market conditions. The debt markets are also expected to see improvement with increased debt availability. However, lenders are likely to remain selective, with credit spread dynamics beginning to normalize. Loan underwriting will reflect broader market trends, particularly in terms of rents and vacancy rates. On the office front, occupiers are shifting back to a growth mindset, which could pave the way for recovery. A slowdown in new supply, combined with a focus on flight to experience, might lead to an undersupply of modern, amenitized, and environmentally sustainable buildings. In the retail sector, positive leasing intentions paired with a supply-constrained landscape will push retailers to explore secondary markets and adapt the scale and format of their stores. The industrial sector is facing challenges with softer demand and an influx of new supply. However, the market is moving towards normalization, which could occur sooner than expected. As for the multifamily sector, while there are near-term uncertainties due to immigration curbs and new supply, the long-term growth fundamentals remain robust. This presents a compelling investment opportunity for those looking to capitalize on the multifamily market's potential. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.